Hello, ladies and gentlemen. It's Wednesday, Modern Investing with Sasha. And here I would like to immediately introduce our expert, Peter Bennett. Hello, welcome to the show.
Oh, hey, Sasha. How are you?
Good. How are you today, Peter?
Good.
Okay, so this is our first segment of the show where we discuss the high-paying dividends stocks, I would say, and we have different favorites in this segment, although some of the favorites probably are the same. And Peter, please take over and tell us what's new in this area.
Well, I mean, first of all, the markets themselves don't know what to do right now because everybody's so a lot of disagreement. Is inflation going to be dominant now for a long time, or is it transitory? But I think it's definitely transitory in most cases. But I think energy is going to keep going up, so that's going to drive some inflation long term. But energy makes up less and less of our economic production in terms of the cost because energy is much more efficient. Like when you had an energy crisis in the 60s, energy was a big input. But now energy is not so big anymore percentage-wise in terms of producing goods. It's still a major factor, but it's nowhere near what it was. So I think that the markets are going crazy because they don't know. Is it going to, is inflation here long term? But, when you consider the fact that, we're coming out of the pandemic, there's the U.S. unemployment. They're paying way too much to people. So there's staff shortages. Everything's adjusting. But even this inflation isn't that much. And I personally am almost positive that in the long run, we're heading for very low rates. And that's the way the bond market is looking now. I bought some treasuries when they were 2.2%, and I got out 30-year treasuries because the 2.2 isn't bad. And then the rates have been going down for the last 3 or 4 weeks, and I made about 5 or 6%. And I said, you know what? I don't want to hold them at 1.9% because I think there's better opportunities. But in the long run, because of the three things I call it DDT, debt, demographics, and technology are all very deflationary. The debt, because the governments are not going to want inflation to occur. So they're going to hold down interest rates, and they can do it very easily using yield control. Demographics, because in aging societies around the world, people sell their stocks to live. They want safe investments, bonds. And technology is very efficient, but it creates deflation and deflationary pressures because it costs less to produce things. So other than housing, which is going to go up in cost because interest rates and energy, I'm not worried about inflation very much, although I hold 4% in gold I'll throw in as a hedge in case the governments lose control of things. But it'll probably be a waste. What do you think?
Yeah. Well, very, very good observation. And in my opinion, the inflation is more or less under control, and especially based on what you said, I agree totally with everything what you just presented. So when you mentioned that aging population, they would sell stocks and buy bonds, again, we was talking about high-paying dividend stocks. I think they get people much better opportunities than bonds at this time, at least for sure, because they're paying sometimes 8-9%. But even those that are paying 4-5%, it's still, I think, beating bonds in long-term and even short-term perspective. And so therefore, I think these stocks are, I follow them almost on a daily basis. And it's one interesting thing is that they are fluctuating to much lesser degree than high-tech stocks like NVIDIA and others. But in a good market, they, generally speaking, all going higher. Now, if it's not such a good market as last week we saw it, some of them are still going higher, some of them are going a little bit lower, but then they correct themselves very quickly. So, and even if they are going down, only yield will become even even higher. Then imagine that stock say $50 and it's paying 8% dividends. So if it go to from $50 say to $45 or even $40, so the yield will become even higher. So if you hold these stocks like I do in segregated account, and I don't have any margins or I'm not selling options in stocks or so on, so I really can't figure out unless there will be some drastic market movement down to say 20%. So that's a scenario exactly where $50 stock would become say $40 stock. So the yield will become, instead of say 7%, it will become 8.5%, maybe
Right. Yeah,
9%.
you're saying the yield protects you on
Absolutely.
one side, and you know what? The thing is, I like to look at it as I'm buying a business. So if I had a pizza parlor or I bought a dry cleaning business or a grocery or any business, I'm not looking at the price every day of the business. If it's paying me income, so let's say I bought a dry cleaner, I'm getting X dollars a year income. I'm not saying, oh, could I sell it today? Could I sell it tomorrow? Can I sell it the next day? Rather, I'm looking at the stream of income and going, this is good. I'm holding this business for life as long as the business is solid. And I just want to get more stocks. And the great thing is other people are doing the work for me, because let's say I buy, P&G, which I recommended, a few weeks ago, and I put over 1% in there because I love consumer staples. I did a lot with that, but I'm going to focus on energy this week, and I'll save some of those dividend picks for later. But so let's say I buy P&G as an example. I'm getting whatever it is. I didn't do the research today on it, but 2.5% dividend, 3% dividend. It's been growing forever, the dividend. So I just hold it, and I've got an income for life, basically.
Plus, they
And
have incredible brands that are making this company quite unique in many,
oh,
many.
well, I love P&G, by the way, going back to
Absolutely.
that. We're going to have a guest enter in a second. We have another guest. But P&G I like because they've rejiggered their portfolio. So they had about 165 brands. They just brought it down to 75 brands. They sold off a lot of them. I'm sure the 75 they kept were in their cash cows and their growth. So what I'm saying is dividend stocks are great because, one, you're hopefully holding for life. It's like a business. But two, they outperform on every level. And you look at 20 years, 40 years, 60 years. In the last 2 months, I saw 3 or 4 studies. They outperform all the other stocks over any period. I even saw a 100-year study. The outperformance everywhere.
Peter, it seems to me that it's a well-hidden secret.
Well,
I think
I'll make that one point that we'll bring in another guest. But you know what? Here's the thing about Wall Street. I worked on Wall Street and finance for 17 years. They don't appreciate dividends, and let me explain why. Because if, let's say, you're an analyst, or you're running a mutual fund, not as much because the dividends will go back in there. But let's say you're a stock analyst, and if the company pays out a dividend, then that's money that's not being used to grow the company. So let's say I'm an analyst, the stock is at 30, and I say, I want to buy, I'm recommending the stock, and it goes to 40. Well, now I look great, but let's say it paid $10 in dividends. It's still at 30, so I don't look good. So Wall Street really has no appreciation at all of income and dividends, which is why I love dividend stocks and MLPs and things, and there's huge opportunities in there. You know what? I'm going to bring in a guest,
please do.
Shaquille Latimer, who is our, I guess, ex fund manager. He just sold a multi-billion-dollar hedge fund.
The
Hi, Shaquille.
recently unemployed bum that I am now, Peter.
Why
Right.
don't you send your resume? please,
Sorry?
please send your resume.
Yeah, that's my plan, actually. Well, I'm never going to apply for a job again, but if I ever did, that's what I'll put on my resume. Experienced bum, and just see what I get.
Well, you could say
Good to know.
experienced multi-billion-dollar hedge fund manager. That's not a
Well,
bad
we
thing on your resume.
don't need to raise these things up. I'm not a politician, Just
It's not
go
your
with
average bum,
the attention
right?
I get.
But that always brings up the issue, like, what do you do, if you are in retirement, or what do you do if you have enough money, because I would point out a few points. One, a lot of people get their meaning from their life from their work. And they get a lot of satisfaction from it. They meet people through it. And as an example, my brother says he knows a lot of successful people in LA, and a lot of them retired and they said, oh, I'm going to go back to work, but then they never really find that opportunity, that they're not motivated anymore. So it's interesting, what do you do, with your time?
I think that in my position personally, so I'm getting a bit of an echo. Is that just me?
Sorry, what?
I'm getting a bit of echo. Is that just me?
Yes, I can hear you perfectly.
Okay, I'm going to echo. I think for me, running a hedge fund, and really to a lesser extent, getting into finance in the first place, was an extension of something that I already loved. So, I'm being a little facetious, and I was sort of joking around when I say I'm an unemployed bum because, one, I actually run 2 hedge funds, and I'm surprised Nick didn't pick up on that. So, he obviously isn't paying attention to me, so we'll have a go at him next time we see him. He is watching, so, but my Singapore fund is still around. But 2, for me, it was a love of trading, actually, right? And it was just that I was good at it, and I realized that I could manage money for other people and earn more than what I would have otherwise. And I have to say, when I was younger, I was a lot more sort of cocky and arrogant, if you can imagine. I was a lot more cocky and arrogant and self-assured of what I was doing. And I used to be of the opinion that why would I manage money for other people? Because it would mean there was less availability of trades for myself, because I have to have all these obligations, and I have to actually put these people into trades that I'm in as well. And, that by default means that there's less profit. So I actually resisted it for a while, but then I kept working on strategies, and I came up with some strategies that were scalable and that would work. So selling the hedge fund, just remember, I haven't sold my strategies. I haven't sold the client base. What I've sold is the management company, right? So the hedge fund management company. So the fund itself is rolling over to Singapore. But
so you will have some work. You still have work that you'll be doing, right?
I will, but I am stepping aside a bit. Like I'm going to step away a bit. And look, I have to tell you that's been a difficult thing, because I do treasure my reputation, and it's hard to give up that sort of control to other people, when in part, even though I'm not, I'm still technically the lead manager for now. I'm not sure quite how that'll play out, but in part, your name is still originally on it. So, sure. that is a hard thing to do.
It's your baby. It's your baby, right?
Exactly, right. And so to answer your question, let's assume that I was to sell Singapore, sell down the fund, and I was literally not doing anything. I would still be trading. I wouldn't be able to help myself.
So you would just trade for yourself, you're saying?
Yeah. Like I couldn't not trade for myself. And I'd still have, my closest friends and business partners and all that. We'd still probably have our own, because we've declared that.
That makes sense. Because you like it. Just like, I work in health insurance, but now because of changes, I only work maybe 15 hours a week in health insurance, but I spend a lot of time on investing, and because it's kind of the game too, so you want to win the game.
I'll say, Judge Judy, one of her interviews, she said about, when you raise a child, one of the greatest things that you can do for them is not to put too much of your own ambitions and goals into them, but to find, to encourage them to find something that they love doing, and then tell them to find a way to make money from doing that thing, because then it doesn't feel like work. Now, I've had other people say to me, you probably shouldn't do for a living what you love, because then you'll never stop working. But, I actually think, just in my experience, if you find those things that you really love doing, it doesn't feel like work. It's something that you enjoy.
Exactly. We're going to have to take a break now. We're going to take a quick advertisement, but that's a great point. I mean, if you find something you love, it's not work, because you would do it anyway. So, that's really, I thought you would say. So, okay, we'll take a quick break, and we'll be back for the next segment.
Excellent.
Welcome. Today, we're going to look at a unique tax planning opportunity using a little known plan to create huge tax deductions for 2020. So listen up to this not well-known plan called 412E3. And today I have a special guest, Max Culiet, who's a certified financial planner, a registered investment advisor, to help us with understanding 412E3 plans. Max, what is a 412E3 plan?
Well, Nick, simply put, a 412E3 plan is a pension plan that must be funded with qualifying insurance contracts, certain life insurance and annuity contracts. The contributions to the plan are fully tax deductible for federal income tax, state income tax, and typically they save some on Social Security and Obamacare taxes as well.
Max, I have a client right now who's facing a $100,000 tax bill for 2020. Can you do anything for him today in 2021 for a 2020 tax bill?
Yes, we can. The Secure Act allows us this year to set up a plan in 2021 prior to filing income tax returns to benefit the client for 2020 and their tax problems. In many cases, we can, by doing that, deduct $100,000, $200,000, and in some cases, $300,000 or more in this kind of a pension.
$100,000 or more tax deduction in a pension? I thought you were limited to $19,500 in 2020. How did you get to $100,000?
Nick, you're right. $19,500 is a 401k limitation. Every plan has its limits, like a profit sharing plan has a limit of $57,000. Then there are some catch-ups, of course, but a pension plan is different. It's actuarially determined and could easily, based on the amount needed to fund that pension, be over $300,000.
Max, does your firm work with TPA? As a TPA firm, do you work with CPA firms in helping set up these plans? Are CPA firms people that you normally work with?
We work with CPA firms almost 100% of the time on each plan we do. Setting up and administering these plans, we're there to help as the TPA to make sure the plans are designed and set up in such a way that they're in compliance. And we also help the CPAs help their clients qualify for a tax credit this year because of setting up a plan. And as a third-party administrator, we're responsible for filing the 5500 forms, making sure the plan is in compliance with the IRS, the PBGC, and the Department of Labor. And we also employ CPAs. We have CPAs and we have enrolled actuaries, tax attorneys, etc., that work for us to review these plans, make sure we're staying in compliance and doing the things that will benefit the client most.
Well, Max, I want to learn more about these plans. How can I find out about these plans and if these plans work for my clients?
Well, Nick, it's pretty easy. Give us a call. Call me at 877-252-1692, and we'll get back to you. We'll, sit down and have a meeting, or you can even email me at max@nationalpensions.com. Either way, we can then set up a time to review your specific, client and their circumstances, and probably design something that could be very beneficial to them in the future.
Very good presentation. So now is our second segment. We are talking about gold, Bitcoin and cryptocurrencies, and other, some exotic investments, if anyone came across about. So let's start with, the shortest one, I think, will be a Bitcoin, because we are watching almost daily at wild fluctuations. Actually, today is a very good day for a Bitcoin. It's up 1.5%. So what do you think is ahead of us? Maybe, Shaquille, maybe you would like to offer your opinion?
Well, I won't repeat my previous statements that of my dislike of the cryptos and my concerns with what they actually are and what they do. I think that because of a number of factors that lead people to want an alternative to fiat currency, and because of the amount of public hype that there is about alternatives such as cryptos, I think probably, and please, audience, understand this is for entertainment purposes only. This is not a financial recommendation, and I'm putting it on the record. I do not trade Bitcoin in any way. I may in the future, but I don't. So this is not a recommendation. Get some professional financial advice. I think that the analysis that says that it will head towards 100,000 a coin, yeah, probably is accurate. I think it may get there. I don't think it'll get there for reasonable reasons. I don't think it's going to get there for anything that's logical. A bit like the tulip bulbs, right? Like, I'd like to think if I was back then when the tulip bulbs, were going through the roof, what would I have said? I wouldn't have invested in them because they wouldn't have made sense to me. But
So
I would have thought they're probably still going to go up, even though I think it's a ridiculous investment. I think it's going to continue going up, and I think that's probably the case with Bitcoin. I think there's probably still some legs left in it.
Well,
Peter, what about you?
Well, the tulip bulbs in Holland are a perfect example because it's all about timing, but nobody knows the timing. So all of a sudden, tulip bulbs were worth $200 in Holland back then, hundreds of years ago. And I don't know the exact date, but I know it's a long time ago. But so it's sort of like a Ponzi scheme in a way because there's no intrinsic value. And I know some people argue for the intrinsic value, but so somebody makes money because it's going up to $200, and then somebody loses money in the end when it goes back to zero. So it's impossible to judge these meme stocks and these things because it's all what people are feeling. It's not based on any rational thing. But what I don't like, and it could go to $1 million or zero. One, I wouldn't touch it because, I like energy stocks, I like dividend stocks, I like MLPs. These are all solid. I can look at them every day. I get my dividends or I get my option play and I understand it and there's fundamentals. But when you look at the cryptos, first of all, even this last month, look at China. Just not only did they ban crypto, but they're banning mining. And 75% of the crypto mining happens in China. I believe it's 75%. And that's because Bitcoin particularly, one Bitcoin transaction equals 473,000 Visa transactions in terms of the energy used. And Bitcoin alone, not counting the others, is using 0.6% of the world's energy. This is not ESG at all. This is not, this is exactly opposite of
What's for our audience? What's ESG?
Oh, you tell me.
I don't know. Environmental something.
Right, exactly. It's environmental something. I don't invest as an ESG, but it's not the proper things to do. Which I don't look at.
Can I just say something to you, Peter? The points that you raised, I think they're all very, very valid, and I think this is where I say to people, including people who are institutional investors who are looking to invest with me, and they'll ask me about certain areas, and I don't feel the need to justify why I don't invest in certain sectors, why I don't like certain sectors. I explain why, but I won't justify any more than that. Let's take tech. There is no question that the tech sector and just the NASDAQ index in general is a great sector to invest in. There's enormous innovations that are going on in that area. I will invest in the index, but it's very rare that I'll actually invest in individual tech stocks. I sometimes will. If there's other things happening, I sometimes will, but it's pretty rare. Certainly as a long-term buy and hold kind of thing, I'm pretty adverse to the tech sector. Now,
let me just ask you. So, do you do the Q for the investors? Do you do QQQ, or do you, which is an index fund, of all the Nasdaq, or do you do a certain? How do you actually do it? Because just as a footnote, I do individual stocks with options like Amazon, and I sell the options.
Let me come back. Let me do a Jen Psaki and circle back to that.
Okay, go ahead.
Another point that I wanted to make. Just quickly, what I would say to people, and I say this just in general, my concern or my apprehension, if you like, with tech, is I don't understand it. I understand they have, used accounts and all that sort of stuff, and that's the reason why these companies will increase in value. But the bottom line is, I'm better off with more traditional things, and especially banking stocks, energy stocks like you talked about, all that sort of stuff.
They're simpler to understand.
That's right. Now, that doesn't necessarily mean that I'm going to buy and hold a bank. I might think the bank stock's going to go down, but I think I've got a better feel for that sector of the market. Whereas tech, I struggle to really understand their revenue models and all that sort of stuff. The reason I say that is I don't think when it comes to investing that there's a right or wrong thing. I think it is, what do you
there is in the end.
What are you? Well, what are you good at? What do you understand?
Right. No, it is important to invest in what you know. I think.
Right. No, you just said, well, it is in the end. Well, okay. Let's just say that I'm a master of cryptos. Okay.
Right.
And this year you make 25% on your account, and I make 35%. Or you make 5%, I make 8%. Does that mean that you're an idiot because you didn't do what the same investments as me? No, of course not. It's just that I understand that particular sector of the market better than you do. I trade interest rate derivatives. I trade yield curves. I trade the yield curve of one country versus another. So I will bet on whether I think the UK.
And just to finish, though, the governments of the world are all going after this stuff. In July, there's going to be a Fed report on it. Janet Yellen is opposed to it. They're talking about potentially huge capital gains taxes on it. No government in the end is going to want to lose control of their money supply at all. I mean, that would take away all their power, half their power. That's why I like gold and silver much better.
Well, that's the point that I made with one of our previous guests.
But what I was saying is that gold and silver, at least it's not as complicated. It's a hedge against people losing control, because my theory is the government interest rates are going very low because of the three DDT, which I said before: debt, demographics, and technology. And the 40-year trend, by the way, which has been a straight line down, and because they're stimulating the market. So I think we're in a bull market, by the way, for 5 years, 6 years, maybe 8 years, until that interest rate goes down to almost zero in the United States. Then it's like, how do they stimulate from there? There's no more stimulation, and that's the problem with modern monetary theory, which is you can print money, but in the end you have to pay the interest on it, and when you have to pay the interest on it, eventually you don't want interest rates to go over zero. So, but that's why gold and silver could be good too, because those hedge it in case the governments lose control. And if they really lose control, gold and silver will soar. What do you think, Sasha?
We're talking about all the cryptos. The issues that we have with Bitcoin are the same issues that we have with the other cryptos.
Right. What do you think, Sasha?
Well, what I think is, I was following Bitcoin for a while, and I was trying to find a correlation between prices of for Bitcoin. I wouldn't talk about other cryptos because, first of all, there are just too many of those. Second of all, I couldn't figure out what's fundamentally different between Bitcoin and other cryptos. There are differences, I'm pretty sure about that. But since I was not interested in that segment of the market, I didn't really follow much of it. But the only thing is, okay, Bitcoin is widely known and followed. And I was trying to find correlation between prices for Bitcoin and either gold or S&P or any other known quality.
Did you find that correlation?
I failed. I couldn't.
Oh, okay. So there is very little correlation.
That's my point.
You know what? Because gold has some fun.
If you're a pair trader or a relative value trader, you want to generally trade within the same industry, or you want to trade that industry versus something else. So to be fair, and I actually know a couple of guys that are pretty good at this. You may not trade gold against Bitcoin. What you might do is trade Bitcoin versus the value of Ethereum, not because you're betting on whether they will outperform the market, but what they will do relative to each other.
Right, you're saying like if you're a trader, but that's a whole separate thing, and I don't think any of our investors or very few watchers would be in that. None of us are in it because we don't even want to touch Bitcoin. But we're going to have to take a break. We're going to take a break.
I don't give our audience the impression that you can't or shouldn't do that. It's just that the three of us are no good at that. But
I'm sure look, somebody can trade any market. We could trade pork bellies, right? But the point is, that's not what most
No,
people
all goes for fun. I'm an ex-killer.
most people are not going to want to be pork belly traders, and most people probably aren't going to be crypto traders. And again, people make money in crypto, people lose
But
money.
there is a big difference, Peter. Hold on.
What's the
Pork
difference?
belly is a kind of a tangible product, and you might even get delivery.
Right, I'd rather have pork belly
to your
than
house.
You trade pork bellies over frozen concentrated orange juice back in the day. Awesome.
Right.
That's right.
Yeah, exactly. Okay, let's take a quick break, and we'll be right back.
Excellent.
And Guidry goes, let's go look at something that took place 40 years ago. Who cares? Okay, that's political.
Very good. And
Good segment, right. So now let's discuss now the options as the vehicle for protecting your investments and actually gain and generate additional cash. As I said many times before, in option trades, there was only 1 year, 1987, the year of the crash, where buyers of options defeated sellers of options. But it was only 1 year since 1972 when options made its debut on Chicago Board of Trade until now, 21. So generally speaking, I would prefer personally selling options, whether covered calls or selling puts if you are interested to buy certain stock. Let's see, for example, right now I'm interested in stock PayPal. And I've just initiated new position. I've sold the puts on a PayPal. There's a very good premiums. And I don't mind to be exercised and actually acquire, which so PayPal is now about $300 a share. It was much higher just a while ago. So in my case, if I will be exercised, my price will be $290. So I think.
are you saying that you sold the 290 put?
300. No, I sold 300, but I got $10 premium.
Oh, okay. So you sold the 300 put for what date?
Actually, very close. I think July 27th.
And what's the argument for PayPal? In other words, why do you believe in PayPal right now?
Okay, the PayPal is they have a unique system of generating transactions, which are quite low in cost, and they're very comfortable to use. I've used PayPal myself, and I found they're a very user-friendly interface. They are much way simpler than transfer bank to bank, for example, and you can hold some money on your account and you can transfer money from your bank to PayPal instantly. So it has many advantages, and it's getting more and more popular. I think almost all businesses now using PayPal, those that involve, for example, electronic commerce. And if that's a way that the way of the future is that electronic commerce will getting more and more popular, more and more transactions will be done through PayPal.
So why only July? Why such a short trade? Just to
He sold the option, so he wants to say that.
right, but why? Explain that. Why did you go July? Why didn't you go longer?
If you exactly, if you look at the options and the way the premiums are being generated and assessed, normally when you sell close options, whether calls or puts, your premium, if you will calculate it in days, weeks or whatever, you're getting much more percentage as a premium rather than, although I do sell long-term options too. For example, I initiated trades on NVIDIA, as you know, Zoom communications, but there it's a different strategy. I don't do that to be exercised and actually acquire that stocks. With PayPal, it's a different story. I didn't sell calls on PayPal because I'd like actually to acquire.
Oh, so you would like to own PayPal?
I would like to own PayPal, but instead of paying straight $300,
Right,
I
it's a
said,
way to buy stocks at a discount.
yeah, I just sold a week and a half duration the put just to acquire the stock. Now, if I will not acquire the stock, so those few hundred puts that I sold, it will generate a few $1,000s profit if they will expire worthless. If not, I will own 600 shares of PayPal. That's my strategy. Now, once I own that, and depends how the market performs or so on, I have, like in chess, I always like to, when I make my move, I always would like to see what my opponent is going to reply with. Okay, if he will do this, I will do
Right.
that. If
Yeah,
he will
it's
do
always
this,
good to have a plan B. I always try to have a plan B and a plan C in investing,
right.
just in case.
Okay, so I have that
So,
plan. If
so
I will
let me say a couple of things to your to Sasha's stuff there. I don't personally, because that was and probably still is my specialty is options trading, and much to the bemusement of many people. And I spent a lot of time actually with ex-Ford traders from Chicago. And I told them that after many years of trading options, I believed that buying options was the best thing that I ever did. And you're quite right, Sasha. 90% of options expire out of the money, so why the hell would you buy them, right? Look, I don't like the way that people talk about selling naked puts as being a way to buy stock at a discount. I don't like that because I think if the market moves down substantially, you're going to get assigned, but you don't get the upside. So what you're hoping for is a moderate move down so that you get assigned and then the market bounces.
Right. You're absolutely right, Shaquille. Lose the upside if it starts moving against you, although you could always buy in then, but then now it's more risk to buy in again as it's moving up. So
I think that you want to, I think you want to pay attention to your theta. I also think that it's really important you pay attention to your volatility. But I just want to, I said I'll circle back, but unlike Jan Psaki, I'm actually going to circle back to your question, Peter, before. Would I buy a tech stock, just, an individual stock? The answer to that is the same. It's really the same answer I'd give you if you asked me, would I buy any stock? Which is, yes, I would, but it would be highly unlikely, like 99.99% chance that I wouldn't.
Let me answer that.
Let me finish. It's highly unlikely that I would do it without having some kind of option play as well, or have it hedged something else like relative value. Otherwise,
that's exactly the combination I use. And also, first I was going to address that point, because when you said that, I thought, well, I'm not a tech expert for sure, but I do understand that the winners are winning, and I hugely believe in, first of all, Amazon. I mean, I've believed in it every time. So if you look at the companies I went with generally, and then I'll talk about Amazon specifically. But I've sold options on Amazon, Microsoft, Nvidia, and Google. Although I'm out of Google for the last month or two because I think there's more issues there. There's lots of issues with Google right now. I think it's overpriced a little bit, compared to the others. But these are companies where I don't really need the expertise because they have the expertise. And if there's a company, a small company, that is doing well, they buy them. Although now there's legislation that may stop that, but they're still going to, if somebody does something great, they'll copy them. They'll get around it or whatever. But so take for it. And what keeps happening to me, it's worked great because I do long options, so I get a really big premium. So basically, I have protection. I'll give you an example. Amazon, and but the thing is, it keeps going up through the prices a lot, so I don't make the full profit. But this time I went, when Amazon was around 3,200, I sold a put at 4,500, and I hedged it at 2,500. So I said, okay, but even now, 3 months later, it's a 2-year option. I got a big premium, and by the way, the 4,500, I basically bought it, got hundreds of dollars in extra price, which is premium. So I'm buying it much cheaper. So I had it less than 10, more than a 10% pad in case it even went down 10%, I'd break even. But so But now in
plus you had a protective leg, but plus you had a protective leg, so you weren't exposed the entire way. You had that protective leg.
Well, I
So-
did get a protective leave. I was about to say that I
Yeah.
did it 2,500 just in case of a disaster. But every time I do it, I never use the leaves because these companies are gross. So take Amazon for instance. And by the way, so my thought was, okay, if I do 4,500, it shouldn't go through in 2 years, and in 3 or 6 months, it's already halfway there. It's at 3,700. But so I may have regret that too, but as it's going up, so I just roll it to a higher one, and I leave some of the money on the table. But it gives me huge leverage and a pad in case it goes down. But take Amazon now. So their first quarter sales were up 44% over prior year. AWS is a dominant cloud provider. Year over year up 32%. Their retail sales first quarter was up 41%. And this is not changing. I mean, they are masters at execution. It's amazing. First of all, now most people probably know this, but I go into a store, I buy something on Amazon. I don't like it. I go into the UPS store and I don't even have to box it or anything. I just give them the slip and they take it and they send it back. I have no work. And every day their execution is getting better. They spent a lot of money building the trucks. That was investment. But now they're going to rely less on FedEx because now they have their own delivery trucks. This is a machine that's going to continue for years. So
Agreed.
I actually think I don't disagree with most what you just said there, but I think that it's a dangerous thing to look at year-on-year results if we're comparing it to last year because COVID was different. Of course, retail sales are going to be up massively.
Wait. No, this is
stuff's going to be up massively.
But that was just an example. They've been doing this.
Look,
Amazon came from nothing, and now they're dominant.
Let me get back to trading options just for a sec. Look, people trade options differently, and the reason why I would say that I buy options is because it works for me because I use it as a hedge. Now, for me personally, and also when I was running a hedge fund, the idea behind that is if I can hedge off my risk, I can leverage my position more. Now, I understand I have access to prime broking, but even before that, using a broker like Interactive Brokers, you have access to more leverage than what you otherwise would because you can quantify what your risk is.
Oh, there's no doubt about it. There's a lot of leverage you get out of that.
Yeah, but you don't want to leverage up too much, as double-edged sword, as the old age says. You don't want to leverage up too much unless you can quantify in absolute terms what your risk is. And that's what I use options for. I use options to enter me into positions where I can quantify my risk. And I think that's a really important part of options.
No, very valid, because you can put in a little money into an option if you really believe in the company. But of course, the market's already priced that option to where they think it is. But if you think you can, wait, don't interrupt, please. So if you think you know more than the market, then you can get a huge amount of leverage out of that with very little risk. So you know,
and that Peter, is to me that is the beauty of options, because what you're doing is you're no longer deciding whether the market is going to move in the direction that you think. What you're choosing is whether you think the market implied move is greater or less than what you think it's going to be.
So
and if you get that right, that's easy money.
So Shaquille, now that you're not a hedge fund manager anymore, or you're in the process of retiring, why don't you bring me and the audience some ideas on options where you think we can get that kind of leverage in future shows? You know, whether it's
it's not about the individual options. What I just said is really, to me, what has been the secret sauce of my success. The secret sauce of my success has not been trading directionally. It has been trading whether or not my assessment of the market and the prices implied by the options market is correct or not. Because you know what? When you look at a stock market chart of any company, it's going to go up a bit, it's going to go down a bit, it's going to go up, it's going to do all that stuff. You look at a volatility chart and it's going to do this: straight up, straight down, straight up, straight down. That's pretty easy to trade. You know, you look like a genius when you do it, but it's really simple. If you're here, it doesn't have any other place to go, because volatility-based trading, it's between 0 and 100. That's it. It can't go below 0. It can't go above 100.
Right. So Shaquille, but let's get more practical. And then we have to take a quick break. And then I think we're going to bring in Nick Palavita, too, into the show. But
he's coming on because I had to go to him.
But Shaquille, I'm saying you're absolutely right. I mean, it's brilliant. But I'm saying now that you're not a hedge fund manager, you don't have as much disclosure things or whatever. Why don't you in the next weeks or month or 6 months or as soon as you can get these ideas, bring us some ideas where we can leverage these ideas ourselves. Sasha, Nick, me, and
I'll give you the most succinct answer I can give you.
So we're going to have to take a quick break because it's we're moving on to the next segment after that, and then we're going to bring Nick in too. I'll be right back.
Good.
But I will answer.
Serious?
Okay, so we have Nick Palavina on our show now.
Now I'm going to answer Peter, but before I do, you guys might want to turn your phone sideways so it comes up on my screen and for you. Yeah, Peter, I'm going to answer the question that you asked me. The answer is I thought that you were a friend of mine, but given that you've now pushed me on the point, I'm not going to go from earning millions of dollars by keeping my secret strategies secret to giving them away for free. So I may once again at my very
but
young.
If you're such a
I may want to run a hedge fund, and I'm not well, but I may want to run a hedge fund, or I may want to go work for a bank. I don't know why I would want to, but I might. So I'm going to keep those secret strategies secret. But I go
you better think about that, Shaquille. There's something about giving and receiving. So you give it away, and then you get it back.
I give lots, but
okay. Anyway, Nick, can we hear you? I think we can't hear Nick. I think he might be traveling. So
Nick's muted himself. But Nick, if you turn your phone sideways and put the screen sideways button on, we'll be able to see you in widescreen. You'll be able to see us in widescreen.
Right. Well, we're going to say goodbye to Nick for now because Nick doesn't have audio, but good to see the owner of the IBM TV network. So, Sasha, do we have the next segment?
Yes. First of all, before we will start that segment, two things. Number one is we had a question from Ankit about the Amazon, but I think, Peter, you answered that so explicitly there is really not much to be added. It's a money-making machine. It's one of the best stocks around. That's about it. With Bezos flying into space or he's not flying into space, it doesn't matter whatsoever. Now, I would like to elaborate slightly for 30 seconds maybe or so on that trade with PayPal that I initiated. Essentially, I'm taking a role and functions of insurance company. Someone who holding maybe thousands, if not millions, shares of Amazon, he sold protective puts. He wants to protect his position. And he could have sold those puts maybe when PayPal was maybe $320 a share, maybe even more. So he sold, say, 300 puts to protect himself. So if PayPal will go much lower than 300, he has protection. So he guaranteed the price of 300 to himself. Now, I'm, on the other hand, willing to provide that insurance, of course, not for free. I'm being paid for that. So I'm taking a somewhat small role of insurance company. I will provide insurance. You will get your 300 per share upon small payment to myself of $1,000. And I'm willing to accommodate you on that. So that's really all there is about it. So now let's go to our next segment. We'll talk about what's on our radar. What are we following? What are the next trades that we see as advantages for us, maybe our audience? Although we are not giving any recommendations. Basically, we are trading for our own accounts, but we are sharing the ideas. So, Peter, what would you like to tell us about your ideas?
I would like to say, first of all, there's very limited. I think the market is overpriced in a lot of areas. I think
Yes.
the banks are going to have a lot of trouble because of commercial office space and because of low interest rates in the long run. But energy is a really exciting area. More than ever, I committed to that area. And here's some interesting facts about it. First of all, everybody's assuming that solar is going to replace oil and natural gas, and
Not so
it's a
fast.
point. But the thing is, even in the United States, and if you look at the world, what happens is energy demand keeps growing. And I have a huge list of things I'm going to go through real quickly about the facts of it. But what happens is the world grows, like China and India alone grew 38% in population since the 1990s. They need more energy. And plus, China doesn't want to use coal. So, and even if you look at the EIA, the energy
coal.
inflation, there's some sound I think coming from Nick, maybe.
No, that was me. No, that was me.
Oh, sorry.
Since when does China not want to use coal?
No problem.
China doesn't care. They're not.
Wait. So in terms of energy, there's huge growing demand for energy around the world. And if you look at the EIA statistics, in the year 2040, you're looking at increased use of oil in the United States, even where we're going to have more oil. Natural gas through the roof. By 2040, world consumption of energy is forecast to be up 7% on oil and 29% on natural gas. So, plus you have the other advantages of energy, like if there is inflation, which is where I think there will be inflation, plus the energy investments. And I'll get to these picks in a minute now, but also there's been underinvestment in energy for the last few years. The companies, when the prices went down, stopped investing in exploration. And it's all cyclical. These are very cyclical businesses, but they're also dependable. People need energy. So the last thing I'll say before I get into my picks and what I did, my aggressive moves kind of was, I also looked at the pipelines, and there's something called FERC, FERC, the Federal Energy Regulatory Commission. And FERC, it regulates the pipelines. And a lot of these pipelines, first of all, the market doesn't seem to get this. They're like utilities. So because they're dependable, they have long-term contracts, and also because they're regulated largely by FERC, most of the pipelines. So if you look at, I saw a chart from 2011 to 2021 of the FERC increases. And every year, if you look at 2012, it's a 6% PPI increase. They allowed the increase on the pipelines to go to 8.6. In 2016, it was -3. They allowed -2. Every year, FERC always allows more than inflation. So what I'm saying is these are safe investments. So what I did is the following. One, MPLX, I went to 11%, which is very aggressive for me, but I love MPLX. It's got a 9.3% dividend. It's got a 7.5% price over cash flow. So it's really earning cash flow of about 12 or 13%, and it's increased its dividend for the last 5 years at a 10% clip. So I went to 11% on that. I increased AM and PPD to two-thirds of a percent each because they're paying around 8% dividends, same cash flows, 9 price to cash flows, so they're earning 11. And TRP, which is another favorite, I went to 6%. It only pays a 5.6% dividend, but it's been increasing its dividend at a 14% clip. It's doubled its dividend from 2000 to 2010, 2020. It's the safest one, I think, of all because it's 80% natural gas. So I decided I'm committing more to energy and staples, which I'll talk about next week. But that was my move. I'm going with the energy. These MLPs are a steal, and I don't think solar is going to hurt them for decades.
Yeah, your ideas actually are very well suited, of course, for our first segment, high-paying dividend stocks, and I totally agree with you on those. I own MPLX, and very happy with the stock. Now, speaking about the strategies, I'm looking, my love for NVIDIA. And right now it went down slightly, and I think it's a good idea, and that's what I'm trying to do now, is selling both calls and puts. However, because most likely, especially because of the stock split coming this month, I would look into selling very aggressive strategy, selling 900 put. But
Ooh.
yeah, but expiration, I'm looking at June
Hang on.
next year, June 20.
Wait, Sasha, you're doing that as a result of the stock split. Remember that the options are repriced based on the split.
Yes,
I know, but both puts and calls. So I would look at selling 900 June 2022 put, and at 900, and selling 1,050 call all the same month. So the strategy is that the premiums are going through the roof. I will generate probably well over, probably even up to $4,000 for each position, and um, bearing that stock will go down to say 600, I'm still in the money. It's now almost $800 a share. So there is 20%, 20, even 25% down risk is already into the trade. Now, how high it could go? Yeah, it could go probably as high as probably 1,200. Because before, remember,
Wow.
I was talking about $1,000 a share, but now I think it will move to 2,000.
I was about to say that. I have to interject for our audience. 6 months ago, you said it would go to 1,000, and that's when I started trading. So I sold the 600 puts, then it started going up, and I luckily just in time got out of those, and I sold the 800 puts, and now it's at 800. So I'm a little nervous to go higher, but yeah, you that was a huge winner for me. I have to thank you for, Sasha, because
No,
For me,
I
what
didn't
I
even
would
know
say
who
is
Nvidia
I'm
was.
always, I'm always nervous about taking those sorts of risks. So, nothing wrong with what you guys have done. Just if it were me, I would take protective legs because I think that that's an appropriate thing to do. One of our viewers, Ankin, who's also one of our producers, asked us about Marriott. We've got a couple minutes left. Should we talk about Marriott real quick?
it's fantastic company.
Marriott Hotels?
Yeah, the only problem is whether to acquire stock now or maybe a bit later. It's a question because travel industry is getting out of its doldrums due to pandemics. So the Marriott is if you look into hotels, I would it would be my probably first choice. I'm using Marriott myself a lot when I travel, and just a few days ago, I was traveling to Collingwood. It's a nice area near Toronto, and we stayed at Marriott as well because, of course, I have their card and all the discounts applicable and so on. So yeah, Marriott is a good idea.
I wonder how much debt they accumulated though during this period, and I mean, and there's also the uncertainty about this quote Delta thing, which I'm not concerned if you're vaccinated at all. I think they're hyping it, but the other side is I think the one to play without a doubt is Delta. It's unbelievable. The stock's not moving with the fundamental news, but it's unbelievable what I'm seeing about Delta. Not only they said they're going to hire 1,000 more pilots next year, they just leased planes from Airbus and Boeing for next year because they don't have enough planes because there is so much pent-up demand. And the difference is they're operating cash flow positive now. So it's like a free option on international travel. Domestic travel in the United States has already come back 100%. So if the stock was at 60, 80, way up there, eventually it gets back up there. So I have long-term puts on Delta cover. And by the way, Shaquille, I always like to cover those puts just in case. So you can sell a put below it, and also you always have to watch your margin, obviously, power. And sometimes selling a put underneath it protects you.
Yes, also it saves your margin.
It protects you and it protects your margin buying power too.
Yes. You mean buying a put below it?
Yeah, I generally do that. Yeah, in this case, I sold 75 puts for 23 on Delta. I covered it at 30 just in case, and then I originally at 30, by the way, and then
just for the audience, you mean you bought puts below it in order to?
Yeah, I bought. Sorry, thank you, Shaquille. I bought the 30s, and I also have 65s for the short runs for September, which I can always just roll to the long date if it doesn't work out. Because I thought originally it would be at 60 by September or 55 by September, 54 by September, and I still think it may hit that because the market's going to wake up sooner or later and realize unlike the cruise ships and the hotels that have been accumulating debt all this time, Delta's bringing in cash flow, and they're positive, and they're just ready to take off in terms of the pandemic. And I just point out, people are paying $1,000 for a car in some areas a day, and they were renting U-Haul trucks because they couldn't get cars. And there's pent-up demand. People are like, I've been in the house. I can't wait to travel. And their budgets, all the money's all accumulated. And it's like, okay, I haven't spent any money on a vacation in 2 years. I'm flying. So it's going to happen.
I won't have the time now to wrap up the show. I won't have the time now to address Marion. I'll just say that I think that because the stock's gone up to pre-pandemic levels without there being an increase in people going there, I just am a little concerned about whether the potential uptick in that sector is already priced into the market. However, you should factor in inflation. Just in relation to the cars, though, Peter, I'll just wrap up my comments by saying I've thought this for many years, but especially now, I think it's very interesting to see whether or not there may be a potential play. Because if I was an investment banker, if I worked for Goldman Sachs or JP Morgan or any of those big investment firms, I would certainly be talking to the family-owned enterprise and asking them whether or not it's worth them considering listing. Because they're one of the world's largest hire car companies or rental car companies. And, with Hertz that struggled dramatically and had that massive drop in price and then went up 900% in a week, with Avis budget car rental systems still running, I think that Enterprise would be a very interesting company to look at if you were in that particular sector.
Maybe you should start an investment bank soon.
Well, that's it.
Then you could approach, but you know what, Shaquille? One last point about that. I'll make my last point is about your point, which is if I really wanted to get in Marriott, I don't need that because I'm staying with my Delta. But if I wanted to get into Marriott, you have a play. You could always just sell. If you want to get in cheaper, you could sell a put at the price today for long term or short term, or you could even say I'll sell it a little below it or a little above it, whatever. But there's all kind of options plays you could play on something. That's the beauty of the options. Besides the fact that besides the fact that over 40.
If you're gonna sell a put in order to get the stock at a discount, as people say, at least take a protective leg because you may only get hit.
Yes, I agree. It's always good to protect. But you know what? If you're going to buy the stock, it's just as much risk to sell the put anyway.
Yeah, I'm not recommending that. We're talking about options. So.
I know. All right. Sooner or later, you'll bring us some ideas, Shaquille. Specific ideas. We want specific ideas. Give us some money. Make us.
I'm worried about you, Peter. You live in Connecticut.
The money,
Shaquille. Greenwich crowd is like.
Okay, Sasha, you wrap up
Thank
the
you.
show.
Thank you so much for sharing your opinions with us. It's the end of today's program, and I'm looking forward to see you next Wednesday. Thank you so much, IBM TV, or Book TV now. It's a modern investing. Thank you very much. Bye-bye.
Bye.